Welcome to The Explainer. Today, we're unpacking a massive, incredibly sudden financial movement that is shaking up the Indian banking sector right now. We are witnessing a historic hunt for foreign capital by major institutions. And look, this isn't just Wall Street jargon. This is a move that could actually impact the interest rates on your very own loans and savings accounts. We're going to uncover the hidden mechanics of international banking and figure out exactly what this means for the broader economy. Okay, let's dive into this. To really wrap our heads around the sheer scale of what we're talking about, just take a second to process this number. $3.8 billion. That is the staggering amount of dollar-denominated debt that Indian private banking giants raised in literally a single month. I mean, in the history of Indian banking, we have rarely, if ever, seen such a massive and immediate appetite for US dollars. This isn't just some minor financial adjustment, it's a strategic pivot of epic proportions. So here is our roadmap for today. We'll start with the billion-dollar debt hunt, uncover the real reason for all this foreign debt, and break down the currency risk strategy. After that, we'll explore a very special offer from the RBI, weigh the global trust against the actual costs, and finally ask the million-dollar question, will bank profits actually rise? All right, kicking things off with Section 1, the billion-dollar debt hunt. Who is actually raising all this capital? Well, we're talking about two absolute titans of the industry moving incredible volumes of money. ICICI Bank just raised a whopping $2.05 billion. That includes a massive $750 million five-year bond. And get this, they're already in talks for $1.45 billion more. Meanwhile, HDFC Bank successfully raised $1.75 billion through 3- and 5-year bonds. And that's coming right on the heels of another $750 million issue they pulled off back in June. These numbers are huge, and they set up our central mystery perfectly. Why the sudden, frantic rush for billions in US dollars?
That brings us to Section 2, the real reason for foreign debt and the domestic challenges driving it.
Think about it for a second. These are institutions that already collect deposits from literally millions of everyday Indians. So why on earth are they suddenly looking outward to the US dollar market? To figure that out, we have to look closely at the balance sheets. Let's take HDFC. Following their mega merger, the bank absorbed this massive housing loan portfolio, along with some pretty expensive debt. They needed to systematically reduce these expensive liabilities and replace them with regular customer deposits. Because of this frantic restructuring, their share of loans in total liabilities plummeted. It went from 21% in September of 2023 down to just 11% by June 2024. But here's the catch. While they're trying their hardest to rely on domestic customer deposits, the actual type of those deposits is shifting underneath them. HDFC's domestic deposit growth is leaning heavily on fixed deposits, which grew 14.7% year over year in the first quarter. But as you probably know, FDs are expensive for a bank to maintain. Meanwhile, their cheaper cost of deposits, that's your standard current and savings accounts, dropped from 38% of their total share down to just 32% in less than a year. Simply put, cheap domestic money is just getting really hard to find. Moving right along to Section 3, the currency risk management strategy. How do they handle exchange rates? So, if money at home is getting too expensive, you look abroad, right? But then you run into a huge problem, wildly fluctuating exchange rates. To handle this, banks use a beautifully simple strategy called a natural currency match. Here's how it works. The bank borrows dollars by issuing, say, 3- to 5-year bonds. That money is now locked in. But instead of converting those dollars into rupees and taking a massive gamble on the exchange rate, they just lend those exact same dollars directly to Indian exporters or companies running international projects. The bank earns its loan interest in dollars, which perfectly lines up with the dollar interest they have to pay back to their bond investors. Boom. It completely neutralizes the fear of currency fluctuation. And the really cool part is that this strategy is so much bigger than just the banks themselves. Experts are pointing out that this maneuver provides some massive macro benefits for India as a whole. It brings additional, highly sought-after dollar inflows into the country, which literally physically strengthens national foreign exchange reserves. And a stronger reserve boosts the entire country's capacity to easily meet its import funding needs. So it's a win for the bank's balance sheets and a major win for the national economy. Let's look at Section 4, the special offer from the RBI, which, by the way, is only valid until December 31st. To make all this work even better, the Reserve Bank of India actually stepped in back in June with a discounted dollar-rupee swap window.
It creates an incredible opportunity for rupee liquidity, and the steps are beautifully straightforward. Step 1, the bank brings in those borrowed global dollars. Step 2, they hand those dollars right over to the RBI in exchange for rupees. Step 3, the bank pays a highly discounted fixed swap premium of just 1.5% per year, compounded semi-annually. And finally, Step 4, after a set term, which can be up to 5 years, they just reverse the swap.
Actually, if that sounded a little too much like textbook finance jargon, let's think about it using this metaphor. The gold loan. Just like you might pledge some family gold to a lender to get immediate cash at a super low interest rate, and then you just get your gold back once you pay it off, the banks are doing the exact same thing, but with their dollars. They park their shiny new dollars with the RBI, get immediate working rupees to run their day-to-day domestic business, and then simply swap them back when the 3 or 5 year term is up. It is brilliant. It gives them access to incredibly cheap long-term liquidity, which brings us to Section 5, Global Trust and Actual Costs. We've really got to ask, is this just free money? Well, with all this help from the RBI, it kind of sounds like a cheat code, doesn't it? But first, we have to acknowledge the absolutely immense trust global investors clearly have in the Indian banking sector right now. Look at this. For HDFC's $1.75 billion bond issue, they received a staggering $7 billion in global bids. I mean, it was massively oversubscribed. ICICI saw a very similar trend with bids rocketing way past the $2 billion mark for their issues. The global market is practically throwing money at Indian banks. They are desperate to get a piece of the action. But hold on. Despite this massive demand frenzy, let's be totally clear. This is not free money. The true cost of funding cannot be measured just by looking at the base coupon rate. These bonds are heavily pegged to the U.S. Treasury yield. For example, for HDFC's 3-year bond, they had to offer an 88 basis point spread over the U.S. Treasury rate, and for the 5-year bond, a 100 basis point spread. That extra spread is a strict, structured economic cost required to cover the credit and liquidity risks for those foreign investors. So even with the RBI stepping in to help, hedging is still an unavoidable, very real expense for the banking system.
Finally, Section 6, will bank profits actually rise? Let's look at the final equation.
This brings us to the absolute most important question for shareholders and investors. Does securing billions in global dollars automatically equate to skyrocketing domestic profits? The short answer is absolutely not automatically. Let's break down the basic profit equation here. A bank's net profit is basically the loan interest earned, minus the bond interest they have to pay out, minus those hedging costs we just broke down, minus normal operating costs, and of course, minus any credit losses. So if a bank is borrowing dollars at an effective rate of over 5%, and they only manage to lend that capital out for slightly more in a hyper-competitive market, well, the remaining profit margin after all those deductions might actually be pretty ordinary.
And that leaves us with the ultimate billion-dollar question. How efficiently will these banks actually utilize this massive influx of global capital in the domestic market? Raising billions is an incredible show of strength. It proves undeniable global trust. But as we've seen today, it comes with unavoidable costs. The future earnings of banking giants like HDFC and ICICI, they now depend entirely on execution. They've built the war chest, they have the RBI's temporary shield. Now it's all about how wisely they deploy it. Thank you so much for joining me on this explainer. I really hope it gave you a crystal clear view into the high-stakes chess game happening in banking right now. Keep questioning the numbers, and I'll see you next time.